Welcome back. You're watching Trading Hour, and as promised, let's invite Prateek Parekh from Nuvama Group to join in to discuss the market fundamentals and the way markets have snapped back, especially since the start of April. Prateek, you've been tracking this SMID rally very closely, the small and mid-cap rally, and you point out that the small and mid-caps have recovered almost 11% from their February 2025 lows, which means they have retraced one-third of the drawdown since the September 2024 peak. The fall from September all the way down to February, we've recovered one-third of that with that 11% up move. How would you classify and categorize this recovery? Is it a dead cat bounce? Is it just a rally we should ignore? Or do you think it has more legs?
Yeah, thanks, Rima, for having me over. It's always a pleasure being on the show. I think if you look at the mid-cap bounce of sorts per se, I think the main driver of the bounce so far is owing to the liquidity easing. RBI's liquidity easing coupled with dollar weakness has certainly lifted sentiments of sorts per se. But nonetheless, I think where the concerns still remain or loom large, I think is on the growth and valuations part. First is on growth. Growth, what we are seeing is clearly global uncertainties have increased. I mean, that goes without saying. But even on the domestic front, my worry is that a lot of high frequency data is slowing down. For example, credit growth continues to remain in the soft lane. Further, some of the stronger pockets of the economy, especially the urban part, like real estate, PV sales, electricity generation, all of them are moving much lower. So from a growth standpoint, if I look at it, dynamics has only worsened since February till now. And valuations, they still remain elevated. Now, if we go by history, what we observe is that liquidity does help provide a temporary calm, but for sustained easing, it is very critical that this liquidity trickles down to credit improvement and overall top line and earnings growth. If it fails so, then this rally for it to sustain will be difficult because valuations are still high, earnings are not coming through, and margin levers are exhausted per se. So we at least think that this is a rally to be a bit more cautious about rather than be very aggressively positioned for a next leg ahead.
Prateek, good morning. Thank you for joining in. So by this thesis, do you expect any potential negative trigger to cause a bigger drawdown within the small caps and the mid caps, considering the recovery that they have seen? Because the large caps may have recovered slightly, but not as much as the broader markets have.
Yeah. So yeah, I think it depends on which point you take as a recovery per se, Hormaz. So if you take from the peak of September, I think the large cap drawdown is lesser. But yes, from bottom, mid caps have bounced a lot because they cut it also a lot more. But I think the main trigger for potential drawdown further accelerating in mid caps can come from two or three factors. A big drawdown can come if there is some big global Six Sigma event that happens and there's a global risk off, then yes, I mean, risk appetite across the world, including India, will be hampered. But I think from a domestic standpoint, I think drawdown or time correction, I mean, only time will tell. But I think markets can remain weak owing to growth outlook because earnings estimates are still in mid-teens, whereas the current momentum is in mid-single digits. Somewhere, as and when if growth outlook doesn't improve, then even that itself can be a catalyst for at least mid caps to have a leg down per se, Hamas. And it's not like valuations are very cheap. Either we get very large rate cuts to offset the current growth downturn and revive the growth back up, or markets time and potentially in nominal terms also correct to make it attractive of sorts per se on Mars. Until then, we will mostly be having a cautious outlook of sorts.
Prateek, is there any sector which you're most bullish about? If you had to pick one sector where you've got the highest conviction right now to reward shareholders, which one would it be?
See, I think that is in some sense difficult, but if I have to pick a sector, I think where valuations are on your side and also earnings are not overly high, I think it lies in the banking space. Private banks, insurance, even some of the NBFCs are the ones where we think there is a very meaningful value, where obviously there can be even risk over there as well. But at least from a 1 to 3 year perspective, this is a space where we think the maximum value lies. Because this is a space where valuations are not very expensive and companies do have cost levers to offset the potential downturn if it comes through of sorts per se.
I was just going through your top picks based on your RRR framework, Prateek, and what catches my eye within the rewarders segment is Petronet LNG, Sun TV, Mahanagar Gas. Well, they may have recovered from the lows over the last 6 to 7 months, but their longer term returns are, well, nothing significant to write home about. What's driving your bullishness on names like these, which may have not delivered significantly over the longer term?
Yeah, so I'll just give a brief about the framework. So the RRR framework that we have in our portfolio for selecting mid-cap stocks essentially has three parts. One is what we call as restructurers. These are turnaround stories where currently earnings are depressed, but we think things should improve. The second is reinvestors. These are the consistent compounders. Our valuations are high, but companies have had a phenomenal track record of delivering very good performance and very good execution. The third category is rewarders. These are essentially cash cows where you're not buying them for a big upside of sorts per se, but these are very high dividend yielding companies and with potential optionality of spin-offs, which can be rewarding for investors. So these are companies which you can probably assume as cash proxies in a portfolio, and it's important to have a mix of all of them. In these companies, at least we personally feel downside to an extent is limited, and reasonably good dividend yield should at least help in case if you have a volatile environment of sorts per se or mass.
Right. And the other one, a segment that I wanted to speak to you about, Prateek, is pharma. There is still a lot of uncertainty with regards to whether there would be tariffs on the segment, whether there would not be tariffs on the segment. We start seeing numbers from pharma companies starting today with Biocon coming out with results. I see a couple of pharma names in your top picks as well, Ajanta Pharma being one of them. Where do you position yourself in a sector like this, which has a lot of uncertainty to tackle with, and now with those executive orders being signed in the US to encourage domestic production as well? What do you do with pharma? And in that too, considering it's as wide a basket as it is, you'd go with generics or you go with large cap, mid cap? What do you bet on?
Yeah, again, that's a great question, Hormaz, and I think it's one of the more difficult ones to answer. Pharma currently in our large cap portfolio is an overweight, and our call over there is precisely based on its defensive nature characteristics, reasonably good cash flows, and the improved capital allocation that we have seen across companies in the space. Obviously, if you do have tariffs coming through, and companies facing higher cost of production, then yes, I mean, it is a setback and you will need to reassess them. But nonetheless, at least within pharma, the basket, as you rightly said, is quite wide. Where one can help or position themselves is, get into those pharma companies which are more domestic oriented or which have a higher share of emerging markets. In these space, at least, which we think the risk is limited, or have a specialty pharma company which is focusing moving up the value chain and where a lot of production can be done in US without weighing significantly on margins. So I think from that perspective, pharma, yes, it's a defensive nature and risks are rising, but within the space, there are reasonably good companies which you can purchase and hedge yourself against that risk by buying into either domestic oriented stories or emerging market oriented stories per se on Mars.
Thank you very much. Enlightening conversation, Prateek, as always. We will get into a break, but there's